Bob, we're going to spend some serious time here on the great unspoken, and you nail it in your research note. Stephanie Kelton at Stony Brook has changed the world. She came out with modern monetary theory. We are in an MMT experiment of some type as well. And the financial media is not talking about this enough because everybody sort of wishes the theory would go away, which is unfair to something that's had such an impact. Are you a believer in MMT?
Good morning, Tom. It's hard not to be a believer. It seems like the go-to policy response now in a crisis where the role of governments is to borrow large amounts of debts and deploy it through fiscal stimulus and try to shortcut to recovery. And the role of central banks is to print lots of money and buy that debt and ensure that the cost of the recovery is affordable. I think it's worked. It's hard to see where any pain has been created or where there will be problems down the road. I think we all sense that there's got to be something. What I'd like to see out of Jackson Hole is for the central bankers to say, this is an emergency policy response. This isn't a normal part of our toolkit. They need to draw the line somewhere here.
And I'm not sure, Lisa, and I think this is really important with no criticism of people like Claudia Sahm and Stephanie Kelton. I'm not even criticizing their cats, and they have cats at home. It's very evident on Twitter that they do. Lisa, nobody has an exit strategy from our pandemic MMT.
Well, no one has a sense of exactly what the consequences will be either. Bob, we talk about the potential of some deleterious, to use the same word from the day before, ramifications from the MMT types of policies that you talk about, yet we're not seeing them. Yields are not going up. Inflation, to the extent that it is going up, is recognized as passing and somewhat decelerating. So when are we going to see the negative ramifications from MMT-like policies?
Well, we're at an interesting point right now with Chair Powell and the Fed in the crosshairs of what's going on in Washington. And he's got Jackson Hole in the September FOMC meeting to start backing out of this. But right now, we're well past the crisis and the recovery is underway and we're recovering a lot of lost jobs and we're going to close the output gap by the end of this year. And if MMT continues, with $500 billion in an infrastructure bill and $3.5 trillion in various forms of stimulus, and the Fed continues to print money and buy debt, I think there's a moral hazard there where you're looking at the Fed underwriting a lot of government policies. So I think it's a very good time for the Fed to assert its independence, draw a line in the sand, and say that they're bringing these things to an end now.
When, though, and what commentary do you need to hear to get them to do that? Is that inflation goes from transitory to worrying?
I think that's part of it. I think right now they can point to substantial further progress hasn't been made on a lot of the things that they look at. When they look at where policy rates are, they don't need to be at zero for a lot longer. They don't need the $120 billion in large-scale asset purchases every month. They can move to something that's more normal. I step back and I look at where things are. And if this had been a normal cycle, say going back, I don't know, 20 to 40 years ago, maybe even 15 or so years ago, at this point in the cycle, I'd expect the Fed funds rate to be 2%, around a zero real yield. And I'd expect the 10-year Treasury to be around 3%. About a 1% real yield. So the fact that we're not there tells you the amount of distortion that the central banks are creating.
Bob, if the Fed were to say at the Jackson Hole meeting that they're planning to start tapering their bond purchases September, November, December, at some point in the near future, and indicated that it would be faster than expected, what would be the market response?
Well, I think the market response would be a gradual rise in rates. And I know there's some debate out there about whether Fed tapering leads to a rise in rates or not. I don't get that at all. Let me tell you, if bond prices aren't the very definition of asset price inflation, you've got a central bank printing unlimited amounts of its own money and going in and buying a specific asset class. if that's not how you inflate the price of an asset class, how do you? You look at the negative 1% real yield on 10-year treasuries. I think the first stop is to get to something that looks around a 0%, and we'll get there.
How do you
as they
manage
go
that,
through
Bob?
the tape.
Bob, we're going to run out of time, but how do you affect a 100 basis point move in the real yield? Do you do it off the nominal, or do you do it with the help of inflation expectations?
I think you do it with the combination of both, but mostly with nominal yields, mostly with the realization that you don't have the 800-pound gorilla of the Fed sitting on the bond market, and
Yeah.
maybe other central banks will start to dial down
Bob,
their large-scale
You know,
asset purchases.
Farrell right now is writing on manuscript, Drawdown Meditation, Bob. It's going to be a really important book. I think Barnes & Noble is like waiting with boxes and boxes of it. You got to do a book, Bob Michele on MMT. That would be just wonderful. It would really work.